You want to know exactly what happens when an SBA lender gets involved in the process of you buying a business? Well, in today's video, I'm going to interview one of the top lenders by volume in the US who's going to walk us through the process from A through Z, what you should expect in terms of paperwork, timelines, and processes so you're well equipped by pairing up with the right lender when you're buying a business. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy and scale a profitable business. If you are a small business owner looking to increase your wealth by purchasing a profitable business, or a W-2 employee or working executive sick and tired of the rat race, wanting to get out by buying a profitable business, you are in the right place. Please subscribe to my channel. Don't forget to hit the bell and you'll be notified every Thursday when new videos come out.
Hey, what's up, guys? I'm so excited to be here today. You are in for a treat. If you've been following me and watching my videos, you know that I want the best in class when it comes to content. And today is no exception. I am pleased to have here my good friend and lending partner, Glenn.Giro from Huntington Bank. Say hello.
Leo, appreciate you having me, man. Been a big fan of your channel. You put out great stuff, so it's an honor to be part of your podcast here. Thanks for having me.
Awesome. Well, you guys need to know who he is. So I'm going to tell you a little bit about his bio, and then we're going to get into the subject matter for today. So Glenn was a finance major right from college, started with finance at the University of Tennessee. Go Vols. All right, started in banking back in 2008. So that tells you he's been around for a while. At JP Morgan Chase in Chicago, doing personal banking, investments, and business lending. In 2010, Glenn started to really only focus on business banking, managing complete business banking relationships, which included credit conventional and SBA loans, treasury services, and the like. In 2019, Glenn moved on to Huntington Bank, where he is today, to focus solely on SBA lending. In 2020, Huntington Bank started SBA loans to do an SBA loans nationwide, and he moved to Nashville to grow the Tennessee market, while he also focusing on lending efforts across the country. Now, about Huntington Bank, Midwestern Regional Bank branch footprint with national SBA lending jurisdiction, is the #1 SBA lender in the country by unit. Oh, wow. Okay, we got a force to be reckoned with it. So they expect to close over 6,000 SBA 7A loans in the fiscal year 2023 with over $1 billion worth of aggregate loan value. That is quite an intro, my friend.
Absolutely. Yeah, no, as much as maybe different parts of the bank might disagree, but I think we are an SBA lending focused bank. It's been awesome to be with a bank that supports small business, that puts the resources into it, because it takes a lot of people to make an SBA program work. There's a lot of hands that touch every deal, and it takes a level of knowledge of the program and the eligibility and not only the criteria that the SBA sets forth, but the criteria that your bank puts into place. And so it's been awesome. I've always loved working with business owners. And like you mentioned, I've worked with them. You know, I started as their go-to at the bank, right? You're a business owner and you have questions about your account, whether it's for credit or treasury. You know, I manage the entire relationship. So I come from a relationship management background. And these SBA loans, you know, it's a loan. I'm a loan officer. You're a borrower asking for a request of some sort, but there's a relationship there, and it has to be managed throughout the entire process. And so it's something I've always enjoyed. And working with business owners is, from the beginning of banking, what did I always enjoy doing? Talking with business owners. They're always so motivated. It's always impressive to see them have some sort of vision and to help them kind of accomplish something. It's one of the most rewarding things that I've ever done professionally. So I feel lucky to be in this role.
And I should add that how we met, I met Glenn at the International Business Brokers Association annual event in Orlando. And that the minute we connected, I'm like, I really want to work with this guy. He's just personable, knowledgeable, and someone that you can actually learn from. And I'm always looking to learn. So I already learned a few things by working with Glenn. So what I like to do in today's sort of a podcast interview is to let you kind of walk us through the process. I know it's a bit nebulous. A lot of people don't really know. Like, I want you to walk us through the process from beginning to inception, from pre-qual to close. And I think our audience could benefit from really understanding the moving parts within the process of approval that a lot of people don't know about. So with that said, tell us about it.
Yeah, thank you. Yeah, so you've had some amazing podcasts. You've had some amazing SBA loan officers on here, and they've done a great job of kind of saying, like, what does it take to be a qualified candidate, and what is the SBA, what can you do, what can't you do? And one thing that always kind of resonates is the fact that it's, and you'll hear this word, right? It's a deal by deal situation. Common sense. Every bank's a little bit different. Every bank's credit policy is a little bit different, and so you could interview 10 SBA loan officers, and when it's SBA specific, they'll probably give some similar answers. But when you talk about the bank itself, you might get some varying credit appetites, right? We like this, we don't like this, or for this type of request, we might require a little bit higher equity injection the next one. So I think one of the things that a lot of people, at least that I'm talking to, one of big part of our conversation is, what does the process look and sound like, right? Like, what am I getting into? You can tell me I'm qualified, and that's about half the story, right? Because the next thing is okay, well, where do we even start? That's kind of the first thing is like, okay, I think I'm ready. What do I need to do? And so, what typically happens is you have the initial conversation, right? Pretty straightforward. This is what I do. This is kind of the bank I work for. Tell me a little about yourself. Tell me a little about your request, and we can kind of go from there, right? So we can focus on business acquisition. So usually somebody comes to me and either says, I want to buy a business. I don't have a business yet, but I want to know what I want to qualify for. Or I've identified a business. I want to see if I'm a good candidate to buy it. So obviously those conversations could go either direction. So briefly on the person that doesn't have a business yet, it's a little bit of a pre-qual game, right? Which is always tough. There's no business there. You're kind of missing half the story, but what you can at least establish is a budget, and budget's set by equity injection, right? And obviously getting experience, that's important too. Like, do you have an industry that you're focused on? Or is this just kind of I'm looking at everything and I'm going to see what looks, what looks appealing based on what experience I might have, but I'm not really in one industry. So obviously, depending on what they end up going, the industry experience might come into play or it might not. That situation obviously is fluid. And so what's your equity injection, right? So one of the first things that we're going to ask is, what do you have available to put down on a business? The SBA requires minimum 10%. There's ways to get seller's notes that can lower that to 5%, but that's kind of SBA rule. So understanding a budget, and based on that budget, I can say, okay, I think this is a good range for you in terms of looking for a business. And so what we've really established is just, this is the kind of the price range. This is the price range you're looking for based on your equity available. So that's kind of the first step for the person just casually looking. For the person that's found a business, fantastic. Now we have a story here. We've got you as the borrower. I can have you fill out a personal financial statement, see your assets and your liabilities. I can gather your resume. I can see what your background experience is. Is it applicable to the business we're buying? And then hopefully we're able to gather some financials. And with those financials and kind of playing with some numbers on the loan, we can kind of figure out what the debt service is going to be. And I know one of your favorite terms, Leo, is debt service coverage ratio. We can figure out.
DSCR. Yeah.
Does this business? Yep. Go ahead.
So let me interject. So just so we're clear, because I understand lending quite a bit. A lot of people do not have or get the tax returns when they're looking at a deal. Sometimes the broker conceals some of that and they give you a write-up. So we may have a combination of internals and some tax returns. How do you navigate those when you're talking to a borrower who's already talking to a broker and they don't have all the information?
Yeah, so P&Ls are common, right? You get a SIM or an offer memo, business listing, and this is where the broker hopefully comes into play. A really good broker, right? A really good broker should be able to help guide those P&Ls, because you know what, they should be doing the Adbacks calculations too, right? Like a good broker should have the P&Ls and the Adbacks, and with that information, you hope that it matches the tax return. It doesn't always, but you hope that it's pretty close, right? Because it's a pretty big waste of time if they provide P&Ls and we're running numbers based on those P&Ls, cash flow looks good, and then you get the tax returns and they're completely different, right?
In a huge variance, right?
And a huge variance. Now I'm questioning the integrity of the broker. Like, what did you think was going to happen? We were, and then the business owner all of a sudden is like, okay, he's not being forthright on his P&Ls based on his tax return. So if there's not a really good explanation as to why there's a variance, then do you want to do business? Do you want to buy a business from somebody who's not really being forthright with information? So I will run cash flow with P&Ls, and I usually give people the benefit of the doubt because most people do know that needs to be accurate, right? There has to be some sort of, equal values on revenue and net income and expenses and Adbacks, right? Like, so I have no problem doing a term sheet or something based on company prepared financials. So that part's fine. And so then go ahead. I'm sorry.
Yeah. So I had an actual situation that happened. May not be one of the deals you and I are working on, but there is a situation in which package from the broker to remain confidential. Package from the broker, sales side, I got the buy side. The broker sends the SIM, and in the confidential information memorandum, which we call the SIM, and he gives you the P&L, the P&L for 2022, right? Which we don't have. We have an extension for 2022 tax returns. But then I see all these weird Adbacks, COGS. So the question for you is, what are the acceptable Adbacks? And what are the ones that you question right from the gate? Because you have to do your own spread to calculate the debt service coverage ratio.
And that's great. And it's not a one size fits all approach, right? And you hear this quite a bit. It's a case by case basis. Now, and that some of this comes knowing my credit team, right? Knowing what they're going to do. And that's a big part of this, right? Kind of knowing what your credit is going to look at. Because if you see a company that's got an Adback list a whole page long, and it's kind of $1,000 here, $2,000, and that's how they're getting their their SDE, right? That their valuation is based on adding everything back at 100%. Then there's probably going to be some discrepancy, right? Because we're not going to give everything back at 100%. And I'll give you an example of a big one, right? An obvious one: owner's comp. Obviously, depending on the borrower, we might add back a bunch of owner's comp, or we might not add back anything. It depends on what the buyer's need for a salary is based on their personal lifestyle. And so typically every broker will add back at 100%. Like, that's always kind of baked in. And so that's one where if our borrower does not need a salary, maybe we do a 70% add back. So if the owner's taking 100,000, maybe we do a 70,000.
So you give the owner of the business 100% on the owner side from the 1120, say 1120s, right? You add up, and then you're going to do a subtraction on the replacement of the owner by the buyer, and you're going to give him a 70% credit, say. So say the owner has $100,000 in bona fide comp, officer comp. So you add 100,000 below the line on net profit, and then you're going to do a negative 70,000. Is that what you're talking about?
So again, it depends on our borrower's need for salary. Let's say they've got outside income. Let's say they own another business and they make good money, right? They technically don't need to take a salary at all. We'll probably do a $70,000. So instead of 100 add back, we'll add back 7. It'll be a 70% of the owner's comp in add back, right? So we'll add 70,000 instead of 100,000.
Got it.
So that's an easy one. You'll see things like, you'll see things like family vacations, like multiple vehicles. It's wild. Somebody's cousin was on payroll and they didn't do anything. And so stuff like that, we will typically, like the salary one, again, you give us a W-2, this person didn't do anything. Okay, we can add some of that back. It gets down to like the frivolous stuff, the meals, the travel, the family vacations. And here's a big reason why we have to be careful with some of these add backs is because we have to technically document the add backs, right? It's easy to do a salary because it's on the tax return. It's easy to verify, hey, this person
it's there.
Exactly.
Yeah.
You're saying you spent $30,000 in family vacations. Okay. First of all, shouldn't be running your family vacations for the business. That's fine. Listen, I'm not trying to argue, but you're trying to sell your business. So now we have to get into the weeds of this a little bit. Are you going to send us receipts for $30,000 to verify that we're going to add that back? And we might, if you can show us that your hotel in Hawaii was $15,000 and you want to send us that receipt, yeah, maybe we'll give some credence to that.
One-time expense. It's a one-time expense, right?
Out of that 30 grand, maybe we give you 10 grand if you can send us proper doc. So the point is this, right? The more we have to stretch to make the debt service coverage ratio work, the harder it is going to be for me to sell to credit, because they're going to look at this and say, Glenn, you're relying on Adbacks to make this deal work, and not just normal Adbacks, but like kind of, and that kind of goes back to the owner. And listen, I don't knock any owner for passing a bunch of personal expenses through the business. You do what you got to do. But when it comes time to sell your business, this is where you run into trouble. This is the problem with doing that, is now you are devaluing your business because you're writing everything off. And so, Leo, I know you see this too. It's a little bit of like, what's most important, writing everything off or getting your business ready to sell? Because if you're getting your business ready to sell, you need to clean up your books and keep the personal out of there.
And have your cake and eat it too. You can get the benefit from the tax savings and get the max value on the business. It doesn't work that way, and we both know that. But some of them want to get both. So just as a rule of thumb, because this is personal knowledge to me on the Huntington Bank side. So normally what I would do is I would do EBITDA, right? Earnings before interest, taxes, depreciation. And you get the non-cash charges, depreciation, amortization. So you guys would add those back, right? Or not?
Of course. Yeah, we would.
So
absolutely.
What about the interest?
Yep, interest expense gets added back. Absolutely.
Now, if C Corp, will you add back the income tax?
Income tax on a C Corp?
Yes.
It depends. We'd have to take a look at it. We'd have to take a look at it.
And it's good that we're talking about that, because normally on S Corps and sole props partnerships, you're not gonna, there's our pass-through entities anyway. So and what are the Adbacks that you feel comfortable, like you say, you know what, they make sense. How about one-time expenses? The business was getting ready to be sold and they hired an accounting firm or the broker and spent 30 grand. Would that be passing the sniff test?
Of course. Yeah. I've got one of those right now where attorney fee. And here's the thing, it's key to see the trend. There's a reason why we ask for 3 years worth of financials. So we can see trends, right? If last year you spent $70,000 in lawyer fees and the year before that it was $3,000, the year before that it was $5,000, it's obvious that was a one-time expense, right? And so absolutely, that's an add back, 100%. And that's where kind of digging into the tax returns, because I feel like sometimes those get missed. And if if we're not doing the effort to do it, sometimes it gets overlooked. And so you got to kind of dig through the financials. And that's why it takes a little bit of time to review every deal, because you want to really dig in and make sure there's nothing that's being kind of lost in all the numbers that we're dealing with.
Well, talk about a little detour. All right. We were talking about the process. So let me get us back on track. So we're talking about, you get an initial phone call with a buyer, right? And then you get to know each other. They got a choice. Hey, I really like Glenn and Huntington Bank. I really want to go with him. So walk us through what happens. I'm really interested in knowing how you guys work.
So I'm a big fan of, once I have a full financial package, I'll run the spreads, I'll build a loan sources and uses spreadsheet, and we'll jump on a call like this, and I'll share my screen. I want you to visually see how the loan looks. I want you to see your equity injection. I want you to see the seller's note. I want you to see the loan breakdown, the fees. And then I also want to show you cash flow, right? This is not a secret to be held at the bank. This is for us to look at together. And I want you to see exactly what I see, right? So here's the debt service. Here's the cash flow, and here's the ratio, and here's the money, kind of obviously the excess cash flow, right? And I want them to visually see it, especially if we're having issues getting to the ratio that we want, right? Let's look at this together. Like, I'm not trying to hide anything. I want this to be full disclosure. Here's what I see. Let me know, let me know what you think based on these numbers. Does it seem about right? Is it about what you're expecting? And then after that, yes, Glenn, you know what? Everything looks good. I think we're ready to move forward. So full financial package, right? So then it goes to me. We have an electronic application, just like most banks. So I'm entering the details, the business name, the social, borrower's information. So I'm manual entry. And then what I think is one of the most important parts of this process is my opportunity memo, right? My write-up. And in that write-up, I'm touching on a lot of things. Obviously the loan details, like the underwriter's going to pick this up. He should read through this and be like, okay, I like this deal based on this. This was pretty good. Because what I'm doing is I'm putting all the loan details, equity injection, where it's coming from, what is their post-injection liquidity looks like. I'm reviewing, here's the business profile, here's the background, here's the industry information, here's their competition, here's their vendors, here's revenue trends. I'm talking about Adbacks. Any Adback that I'm putting on my spreads, I need to explain why I think this is an Adback and why I did it at whatever percentage. So I'm kind of building the case, strengths, weaknesses. I'm laying it all out there. And the goal is that here's my case as to why we should do this deal. So application gets submitted, my nice shiny opportunity memo, why we should this deal's done, submit, then it gets routed to underwriting. And that's when the real fun begins, right? You got an underwriter picking this deal up, they review it, they come back with questions. Hey, Glenn, I noticed some things and this, that, they've got tools that we don't have, right? They've got their own cash flow stuff. We don't use the same things. I think that's intentional. We're not underwriters.
Really?
I'm not an underwriter. I don't tell people I'm an underwriter. What I do is I try to get out in front of any major issues I see. I can calculate cash flow. I can know if you're a qualified borrower based on some simple metrics, right? But they're going to go in and they're really going to kind of get granular, and especially if it's complex, right? Like sometimes we'll have a borrower that has 20 rental properties, things like that just can kind of throw a deal a little bit, in a little bit chaos when we start talking about global cash flow, right? Because all those properties, income, now you got to factor all that into the scenario. And so, underwriters reviewing it back and forth a little bit. And then obviously one of three things: approval, maybe a counteroffer, or decline. And so, obviously with an approval, great. Sounds like everything's good. Obviously counteroffer, depending on the request type, there might be a little more back and forth before they issue kind of that counteroffer, because if it's a business acquisition, they can't counteroffer if that's not what was agreed upon, right? But they might come back and say, hey, Glenn, we need a little bit more equity injection, or here's some things I'm seeing where cash flow is becoming an issue. And so I might go back to the borrower and say, hey, we either need to bring more cash, or maybe adjust that seller's note if they're willing to find something more, or adjust purchase price, right? It's kind of something along those lines.
Right.
But obviously it's an approval. Fantastic. Next step, commitment letter, right? Here's our commitment to lend. That term sheet I gave you, honestly, it's a paper. It's just a piece of paper. It doesn't have much value to it. Now this commitment letter, that has value. We've underwritten the deal. We've looked at all the numbers. We've looked at you. We're ready to obviously move forward in this process, right? So sign that document, get it back to me. And now we're into post-approval, which I was kind of, joking with you, Leo. I always say kind of the easy part's getting the approval. Post-approval, it's all about due diligence and satisfying the SBA requirements, right? There's two things going on there. The SBA is saying, hey, if you're going to close this loan, here's the stuff that we need to make sure it's compliant with SBA. And then the bank is also doing due diligence with the idea of, hey, we're going to protect our borrower by doing some, business valuation and things like that to make sure that they're getting a good, clean business, right? And so I don't know if you want to stop there and see if there's anything you want to talk about before I start kind of getting into the rabbit hole that is post.
I love this, man.
Process.
I love this. This is unique. We haven't covered this before. So guys, as you're watching this video, this you're not going to find in many places. This is the real thing. Hey, so before we get into that, on the approval process, can you give us some timelines? So say borrower call you today and everything goes smooth. How many days and weeks does it take to go from one stage to the other?
Yeah. I love something somebody you recently interviewed said, which is timelines with SBA, right? We have to give timelines because you got to give them some sort of idea of like, hey, when I kind of expect, if everything goes well, that we could potentially close. We say 30 days, 45 days, but I love what they said. You got to remember, we're working in business days, right? Like 30 days sounds nice, it's a nice clean number because it's a month, but
it
like,
really is 40 days.
Yeah, exactly. So, I'm gonna kind of do a cop out here. It's a case by case basis, right? What level of due diligence? Now we'll say this on the applicant, because I would say it's much more predictable on submission of the application to approval, which is, I believe, what kind of your question was. And I'm kind of really jumping ahead to those people. So I would say this, typically an underwriter has it in their hands within a week to 2 weeks, and they're reviewing it. And obviously, depending on the complexity and the biggest compliment to me is when an underwriter picks it up and approves it and doesn't have any questions. To me, it's just like,
really,
that was a nice, clean application, right? Like, good job, borrower. And, I'll take a small piece of credit for making sure I had all the information they needed. But, they'll always come back with questions, right? There might be a little bit of back and forth. So I would say on average, give it about 3 weeks, right? Give or take a week to get an approval. And then once the approval has to go through, manager probably has to follow up, make sure eligibility person just needs to take a glance at it, make sure there's nothing that was missed from a pure eligibility standpoint. And then I get the green light to order the commitment letter. So from application to approval, maybe 3 weeks, maybe commitment letter in your hand within another week. And that's just a standard lead time, right? That's not hair on fire. I need this thing yesterday. There's levers we can pull to speed that up. But I don't get a lot of it happens, right? I get that. Like, can you get this done in a week? And if I think we can do it, I'll say yes. Let's do it. This is a great deal. Shouldn't have much resistance. But for the most part, that 3-week lead time is what I tell people, and we can hit that from more times than not.
Okay, so we're 3 weeks now post approval, and get into as nitty gritty as you can, because you mentioned something that I want you to expand on is business valuations, and how do you go about doing that? And so as you're talking through everything, please, as much as the secret sauce that you can share.
Well, you notice I said I'm not an underwriter. I'm not a business guy either, right?
That was your caveat right there. That's my disclaimer.
Yeah.
I'm not an underwriter.
Listen, sure, we could do some simple, multiples of seller discretion earnings, multiples of EBITDA. There's ways to get a general sense. But business valuations are tough, right? Especially when you're looking at 3-year trends. If 2022 spiked and the previous 2 years weren't as strong, obviously we can get year-to-date financials to hopefully show the continuation. And you can make the case that really we should look more at last year and kind of the continuing of this year. And vice versa. If 2020 and 2021, the businesses that spiked with COVID, right? You saw the kind of it shooting up. And let's say 2022 shows now kind of a second year of declining revenue trends because 2020 was boom. Business valuation is going to look at that another way, right? And that's where we're definitely going to want to see year-to-date trends, because if year-to-date you're showing, year-over-year comparables, January through May of last year, January through May of this year, if you're showing declining revenue trends again for technically the 3rd year in a row, now it's a little bit like, all right, what kind of business do we have here? It's right. Sure, things were great, and you could still be very profitable throughout that entire time. But if revenue's dropping and maybe net income starting to tail off as well, that's going to impact valuation. And so I leave that to the professionals. Obviously, I do some rough calculations, and we have some internal credit stuff that we do to make sure the loan amount makes sense based on essentially cash flow, right? So, but yeah, it's a hurdle, and they'll come back. I've got somebody that I use, and we've got a great working relationship. There's a lot of times I'll jump on the phone 3 or 4 times for a business valuation, and he might come back to me and say, "Hey, Glenn, it's getting kind of tight. Let's talk about it." And then I'll go back to the borrower and the broker and say, "Hey, listen, is there anything that we forgot? Is there anything that we missed in terms of from a cash flow standpoint?" And that can be, the owner's vehicle was not added back, right? That during the vehicle insurance and the car, little things like that surprisingly could have some impact on the valuation. But yeah, that's a hurdle. That's definitely a hurdle, and that takes that can take a couple weeks.
So I know some lenders have this kind of a fallback position. Say you approve it on the normal whatever interest rate that you deem is necessary for this to get this deal done. Debt service coverage ratio is healthy over, say, 1.5 to 1. And then I've seen lenders go, okay, normal case scenario. Now let's put a stress test. What if, the stress test is, what is our fallback position? How low does it need to be? And do you guys have some ways to, like, okay, this is how normal things, but what if this happens and can we still do a loan? Or a year from now, if this happened, the stress test will cover it? Do you guys have some type of thing that you kind of a fallback position?
Yeah, you find referring to like a stress test interest rate when we're doing
cash flow, or something that you might.
We're always going to do cash flow, obviously at a higher interest rate. Usually it's a couple percentage points above where prime plus a spread is, right? So of course, right? And projections, like a little bit of combination, and projections are becoming kind of important now, right? And I think that people in the past have been kind of glossing over the importance of projections. Anybody can throw numbers on a piece of paper and just think that, 2 million this year, 3 million next year, 10 million. It's just like, yeah. Nobody's ever put projections where they're losing money, right? And so
no, projections. I mean, sorry, I didn't mean to. As the owner of an accounting firm, long before I was doing
SBA loans. I was doing acquisition loans. I was doing SBA working capital loans, in which even the lenders would want projections. But what is how do you know, like when you're asking a borrower to put the projections together, are you assuming that the reason, and correct my premise, my hypothesis is that the lender is looking to see how the borrower, the future CEO, thinks about how to work the business, how to manage the P&L. Now, what if how do you guys know that the buyer did not do the projections and somebody else did it? Maybe they hire a third party. How do you ensure that the projections are legit?
Hey, do you need help with buying a business? If so, please reach out to me. You can either drop me a comment below and begin that conversation with me, or you can send me an email. My email address in the description section of this video. And let's set up a time to chat. I want to help you on your journey to buying a business. Thank you.
It's a great question. And I sometimes battle with what I should say when I see projections that might be a little bit out of line, because at the end of the day, I'm the finance guy, right? I try to stay in my lane. And my lane is to kind of coach you on, how to best, how does an SBA loan work and how to best qualify and the things we're looking for. When it comes to projections, I will say this. I've got an underwriter behind me, and his job is to look at those projections and see if they're unrealistic. And they've done this before. Well, they'll say, listen, industry averages. If you look at the percentage of of net income, historically speaking, and now all of a sudden this thing's going to spike, and this was now it's 50% gross net income essentially, right? So they're going to go back behind me and they're going to pick it apart. And they'll come back and they'll say, hey, we had to adjust income on this cash flow. And so again, that's where if something is outrageous, I have no problem saying it. But like also there's a little bit of me saying at the front end, like put some thought, put some time in these projections, like do an honest assessment and then get those to me. And then I submit it, right? And then I've got somebody behind me that's going to really do a deep dive into that and make sure that they make sense.
Post approval, my friend. Now I'm take it away.
Yeah, so we covered business valuation. So I kind of grabbed an example list of what are the items we might need post approval, because I think
you want to share that or on the screen, or how do you want to do this? Or you will
I'll just read it. Yeah,
okay,
I'll just kind of talk it out, right? So there's a few things going on here, right? There's due diligence on the borrower side. There's due diligence on the business side. And then there's obviously items that we need to satisfy kind of SBA requirements, right? And so obviously, if you're buying a business, if it's an asset purchase, obviously you're going to have to establish your own LLC or your corporation. So we'll need to see those articles. We'll need to see your tax ID, your SS4 letter from the IRS. So those are pretty basic things. Operating agreement, if you got one, we want to see it. If not, we have a document that says there's going to be no operating agreement. So typically, if you're just a single member LLC, you're typically not going to have an operating agreement. Commitment deposit. So obviously, we're going to be ordering some third party reports that have fees attached to them, right? So commitment deposit is just a good faith deposit, and that says that hey, if this deal doesn't go through, the borrower is still responsible for these third-party reports, right? You don't just get to walk away and the bank pays for all the appraisal or valuation things. So good faith deposit, all banks are going to ask for that to kind of cover themselves, right? As far as the business acquisition, purchase agreement, usually purchase agreements have a few different drafts, a few different updates. Usually the first purchase agreement you sign is going to get amended a few times. That's pretty common. The first purchase agreement you sign usually is between the seller and you as an individual. That'll need to be updated usually with the business that you started, right? So just small changes like that. The closing date might have to be shifted, all normal things, but we just need, at the end of it, we just need a kind of your final kind of purchase agreement. Bill of sale, what are you buying, right? What are you buying? Usually need to be signed off by both parties. Non-compete, think about this, non-compete. You need to protect your business, right? I couldn't think of a worse case scenario than you buy this business from this guy or girl, and next you know, they opened up a similar business like a couple
10 miles away,
right? Yeah. So you better protect yourself. So of course we require a non-compete, and that, we have like a minimum, I think it's like 3 years, 25 miles or something like that. But your geographic location better than we do. You can do obviously above and beyond that, right? So do what makes sense. Having a business in downtown Chicago is going to be a little bit different than having a business somewhere in kind of a smaller town, right? 3 miles in Chicago covers the entire, almost the entire downtown. So whereas 3 miles elsewhere, it's a different story. So non-compete, that's a big key, right? Consulting agreement. Do you want the owner to stay around in a capacity where they're going to help advise you for up to 12 months? The SBA allows that owner to enter in some sort of consulting agreement to stick around for 12 months. And, I think I'm not saying you have to do anything, right? But like if I bought a business, I kind of want the owner to not just like hand me the key and like disappear, right? I kind of want them to stick around and help with the transition. I don't know about you, Leo, but I not saying you have to get a consulting agreement, but see if the owner's willing to like help you out a little bit.
My rule of thumb when it comes to that, because I have a bunch of sales side stuff. There is so much depending on how long the business has been around. If the business owner has been operating that business for 20 plus years, all this institutional knowledge that goes beyond the standard operating procedures, the SOPs from the business that you're buying, there is no way that you can download everything into an SOP and the owner walks away. There are many things that I have done sales side interviews prior to creating the Sims, in which I get an hour to an hour and a half worth of downloadable recordings, and still we need another hour to download everything on the brain, and that doesn't even cover day one. So that goes to show that to your point, it behooves the buyer to be friendly with the seller, to keep them so they can download everything into whatever spreadsheets, recorded calls, processes, SOPs, workbooks, PDFs, collateral materials that you may not even be thinking about right now. To me, is like, how long, 3 6 months to a year, the bigger the business, the longer the time around that the owner is going to have to stay to download the stuff. What do you think?
Yeah. And it's also important to figure out the current management in place and how long they've been there, right? Maybe it's not as important if you've had a manager that's been there for 20 years, and maybe the story is this owner is never around, in which case maybe it's not as important, but you better make sure that somebody is going to be there to help with the transition. That's going to basically teach you the day-to-day operations, like you said, the operating systems, the sales cycles, and the customer relation software that they might have. So that's part of it. If you're going to have a consulting agreement, we need to, obviously we need to, we'll have to review that as well. Let me see. Obviously, we're going to order tax transcripts. We want to verify that the tax returns you sent us to run cash flow matches what the IRS has. And I've run into some situations where we order tax transcripts and it comes back no tax returns found. What? And it's because that's happened before. And it's not because the business owner intentionally didn't file their taxes. Their CPA made some sort of error. And here's the thing: you pay your taxes. This is how the IRS works, right? And I don't want to badmouth. They're great people, right? I don't want to badmouth the IRS. But they took the money, and they never said that the tax return, they never got filed, but they collected the money that was owed. So it just kind of went on for a couple of years. And so anyways, that was a headache. But anyway, we verified that the tax returns match, or the tax transcripts we order from the IRS match what the tax returns say, right? So again, protecting the borrower, due diligence. Interim financials, depending on how long it's been going on, we want to see updated interims. So sometimes if for example, right now, if you've only got through February or March of this year, maybe we'll want to see something more updated. Again, just the idea is let's make sure business hasn't fallen off a cliff in the last couple of months, right? Lease agreement. Think about this. You're going to have a landlord, assuming you're obviously not buying the real estate. The SBA loan, when real estate is not part of the loan, is typically a 10-year term, right? You need to make sure the landlord is going to re-sign a lease, renegotiate a lease with you, and give you at least 10 years total to match what the SBA is going to require. And so you got to make sure that they're going to be okay with that. Another thing is this specific location, vital to the business, right? Because you have some scenarios where, technically it's a storage facility, or maybe just like an office, thing, or it's not as important. But like if this location of this space is crucial, then not only do you need to make sure you have a space to operate your business for at least 10 years, but that the rent also, right? You're gonna have to renegotiate rent. Make sure they're not gonna hike the rent up. That happens sometimes. The current business owner has this relationship with the landlord, been keeping the rent super low, maybe under market value. Now you're stepping in next thing you know, the rent's doubled, and that impacts that goes back to cash flow, right? If all of a sudden you give us a lease agreement and rent went from $10,000 a month to $20,000 a month, we might have to go back and just make sure you can still afford the loan with the increase in rent.
Have you seen deals fall apart because the landlord doesn't want to play ball?
Sometimes, at the end of the day, the landlord wants a tenant there. Usually if this business is exiting, they've got a relationship there. It's easy for them just to have that guaranteed. We have to have them. Another document is a landlord subordination agreement, right? So they technically have to be okay. The bank's going to have a lien on all business assets, which means the landlord, if this business owner stops paying rent, the landlord can't go in there and start plucking the equipment and inventory and stuff. That's the banks, right? So there is a document that they have to technically sign off on, acknowledging that Huntington's, in a first lien position. They sometimes will push back and redline it. We can actually go back and forth on that document. If there's things they don't like and they want to change it, we can okay it. But knock on wood, a landlord has not been a reason for a deal to fall through. But it has been a reason why, extended the process a little bit, right? Like there was back and forth.
I'm glad to hear. I've heard of deals being killed by the landlord. For whatever reason, there was a toxic relationship between the seller and the landlord wanted this. And then a new buyer comes in and he goes, perfect. I don't want this business here or something, right?
Yeah. Leo, you're giving me anxiety just thinking about that happening.
No, okay. Let's happy thoughts. All right. So,
happy thoughts, yeah.
So lease agreements, subordination agreements. This is a great list, man. What else?
Yeah. Updated personal financial statement. You had to fill it out at the beginning. You might have to fill it up again. Just again, make sure that nothing's changed from a financial standpoint. Evidence of equity injection. The equity injection piece is key to making this whole thing work. We need to know where the money comes from, and we need bank statements to show it, right? Source and verify, the SBA. Source and verify. If money's moved around a few different accounts, then we got to track it, backwards. Seasoned funds. And so we've had that situation where money left this account, went to this account, and then it moved that account. And we're going back 6-7 months of different account bank statements. Obviously, we just need to make sure that we know the source of those funds, right? So that's a key piece as well.
Is there a formula for post-closing liquidity, assuming that the down payment is sourced? Let's keep it simple. $1 million purchase price, 10%, $100,000 down payment or equity injection. What is there a rule of thumb for post-closing liquidity? And let's also, before I forget, add working capital to the discussion. How do you guys work the working capital, if any?
So, yeah, there is. I like to say it's not a rule, it's a guideline. It's what we like to see, which is 10% of the loan amount. So $900,000 loan, we want to see about $90,000 in liquidity. Sure. If you have less than that, are we building a working capital? Is the owner going to leave AR in your net? They're going to leave you some AR. How strong is cash flow? Things like that. And if it's 900,000 and you have 10,000 in liquidity, that's going to be an issue, right? You're not showing that you have anything in reserve. If something happens, whether that's personally or with the business, you're out of money fast, right? And so we do want to see personal liquidity. It is important. It's very important. And so 10% is kind of the guideline. And then the farther you go below that, the more we're going to have to really find some other big strengths to mitigate, right? And so
to clarify, this is 10% beyond the 10% down payment.
Correct. Yeah.
So it's like, so walking in, if you want to buy $1 million business, you got to have $200,000 to play with.
Correct. And that's why positioning yourself from the beginning to look strong is important, right? Because a lot of times people have the ability to have access to that, right? We're talking about if there's a few different things. You have an old retirement account, right? Rob's accounts can help strengthen your liquidity. You have outside income. Maybe you can get a home equity line of credit, and that can keep your liquidity strong because you're not going to drain your bank account. You might use some funds from line of credit. A gift from family or friends they're going to just help you have liquidity. And so yeah, it matters, right? And that's one of the things I'll always address up front is where's your equity injection coming from, and what is it going to do, or what is it going to look like? What's your post-injection liquidity going to look like? That's always a portion on that write-up. I'm addressing that. I'm talking about it, good or bad. We're talking.
And I love that, Glenn. And you and I talked about extensively during that lunch at the IBBA because there's a lot of buyers are confused, and I wanted you to talk about that, and I'm glad we are because they come to me and they said, well, yeah, I have $100,000 to invest, and I want to buy $1 million loan, and I want to buy $1 million purchase in 3 times cash flow. It's great. And I go, do you own a home? No. Do you have savings? No. Do you have a retirement account? No. Do you have any friends and family that can give you money? No. So if all you have is 100,000, maybe you need to cut that price in half and buy a $500,000 business. Use the $50,000 left over as your post-closing liquidity. You don't have to own a home.
Yep. And that's the conversation I have that you just had, Leo. That's the conversation I have with people is what's your budget? What do you have available to you? And then I'll give you honest feedback of where, the price range I think you should look at. Right. And so again, that's up front. That's conversation from the beginning of like, hey, this is how the SBA loan works. And this is what we're going to look at. So, but super important. I mean, it really just it really should set your expectations of what you can afford, right? Is your budget. It's like putting 20% down on a house. You know, you're not going to go look at a $10 million house if you have $50,000, right? So it's the same mindset, right? We're not going to let you go broke buying a business. It doesn't do you any favor. It doesn't do the bank any favor. And the SBA program is designed to make sure you're a well-qualified borrower. That's why the program has been so successful. It's been around for so long. Is because there's safeguards in place. Because, you know, we've seen historically that some banks get a little bit rogue and they start lending money to people who don't necessarily qualify, and that is not a good situation, right? That's not helping anybody out. The SBA sets these guidelines, and credit, you know, your own bank's credit policy sets me even further guidelines, because we want this program to thrive, right? When the data is pulled on a default, you know, percentage of defaults and things, we want those to stay low so that this program is just a staple in lending in the United States, right? This government program to me is one of the most important programs offered across the board. It helps small business. There's no better program out there other than, you know, helping small business is pretty important. So we got to make sure that we're keeping this program
alive and well. Alive and 100%. Well. And I couldn't agree more.
This program, if something happened to this program because it was getting abused, it'd be devastating.
And you heard me say it, you know, you watch some of my videos. I have always been in the position that the SBA lenders are your friends. They are there to help you. If they don't think this is a good deal that you should buy, you probably is not a good deal that you should buy. You should pull out, right? Yeah. But if you guys feel good about it, then everybody wins. Okay, so we're updated PFS. What else do we have before we post approval and closing?
Yeah, so insurances, right? You got to make sure your business's insurances are in place. Obviously, you know, again, the bank's going to have a lien against all business assets. Not only do we want to make sure you have proper insurances in place to protect those assets, you know, workers' comp if it's necessary, you know, life insurance. In scenarios where there's a lack of collateral, you might have a bank that requires a term life insurance policy, and the bank is usually listed as the collateral assignee. And then you have whoever you want as beneficiary. The thought process, if something happens to you, proceeds from that life insurance policy go to pay down or pay off the SBA loan, with any remaining amount going to a beneficiary. So life insurance could be a part of it.
It's not expensive, depending on your age, term life, or 10 years. I mean, you want it for the length of the loan, right? Yeah.
10 years. Length of the loan.
It's the cost of doing business. That's good. What else?
Exactly, right? It's a business expense. So we talked insurances. Obviously, if you have to pledge a home as collateral, you know, potentially appraisal on a home, you know, making sure your home is insured as well. Miscellaneous items. So licenses, sales, you know, sales tax. Obviously, if you have it's an HVAC or a plumbing, making sure proper licenses are in place. Obviously, talking to the business owner, seeing what licenses they have. Liquor license is always one where it's state by state. It could be different. Obviously, you know, California takes some time to get that liquor license transferred. So you got to build that into your time frame, right? So just kind of truly understanding what licenses they need, and then understanding the process to transfer those licenses over. That's a huge thing. Let me see what else. Collateral list. Obviously, we're going to want to know, you know, what available collateral. Are you getting vehicles? Is there any equipment worth over a certain dollar amount? You know, obviously we'll want to, you know, we might want to have specific liens against specific equipment, you know, depending on the value of it. Obviously any liens against the business, any outstanding loans, those either need to pay off prior to closing or at closing, right? You can't have any this business can't be walking away with still liens against any of the equipment or lines of credit or anything like that. So you got to make sure all that's cleaned up. I'm actually working on a deal right now where they closed the line of credit like a year ago, so they thought they were fine. It popped up on a UCC lien search. It's still there, so they have to go back to their bank and say, hey, listen, you never released this lien. And so something like that pops up that's unexpected. So let me see what else. Site visits. We talked business valuations. Broker. The broker was involved, making sure you get proper information from the broker for banks that pay referral credit. Do you have the invoice? Do you have the broker's information? I think that's pretty important.
Yes.
Yeah, I know you'd like that.
I would care about that.
Yeah, absolutely. I'm a remote SBA lender. I don't have somebody calling me from the branch saying somebody walked in and wants an SBA loan. I get all my deals. They're all quote unquote self-sourced, right? It's partnerships with brokers. It's putting things out there on social media. It's relationships. If I'm doing my job correctly, every deal that I close, that person, when talking to somebody else about, I heard you bought a business, great. How'd you get it done? I got an SBA loan. Talk to my guy, Glenn. Talk to Glenn. And that's the goal, right? That's another walking, hopefully positive, advertisement, right? And so, so those are the type of things that, obviously those are the type of things that'll just be required. And one more thing that I kind of noticed is that don't forget that if cash flow is there, you can build in new equipment. You can build in, inventory. You can build in, you walk into the space and it looks kind of old and run down a little bit and you want to do some upgrades to it. You can build all those things in. And you'd rather do that right now with a loan that's going to stretch over 10 years than take a hold of this business. And in 3 months down the road, you're trying to figure out a way to, now you got to come out of pocket to do some of these things, or maybe you have to get financing for that piece of equipment, but that's a 3-year repayment term and that payment's a lot higher. So, I always tell, that's another thing, right? Like, is there anything you need? Because now's the time to build it into this loan. Obviously, if the cash flow can support it, now's the time to do it. Don't do it 6 months from now when you have to go back and obtain new credit and the terms aren't going to be as favorable. Like, let's build that in. So obviously, if those are the cases, we'll want to see some invoices and things like that so that we can essentially pay for those things at closing.
Yeah. That's great. I do want to come back. I had a call today, somebody who's actually looking to work with me, who said that they have this, the thing that was holding them back wasn't even the personal guarantee on the loan, is how much they were going to have to pledge collateral out of their home equity in the house, right? So is there like a rule of thumb, excuse me, that Huntington Bank looks at when, say you have a house that is worth, well, in California, everything is worth $1 million. So the house is worth $1 million, right? And they have a $500,000 loan. Believe it or not, it happens. A $500,000 loan, they bought it a few years ago. The house is now worth $1 million. There's a delta of about $500,000 worth of equity. There's no second, it's just the first. There's no HELOCs. What do you guys, when you're looking to capture some of that equity, how do you do it? And what do you go for?
Yeah. So we're required by the SBA to try to get dollar for dollar collateral. What's available, right? The nice thing about SBA loans is collateral shortfall is not necessarily a reason for decline most of the time, right? We can do deals. 99% of the deals I do have a lack of collateral, right? It's very rare that it's dollar for dollar collateral, even with real estate, because we can finance, obviously, depending if it's an expansion versus startup. But the idea is you can finance 100% of a real estate purchase for an existing business, right? The advance rate on the real estate might only be, 85%. So technically we're in the whole 15% on that collateral value. So that scenario you said, $1 million home, 500,000, 25% equity is kind of the magic number, right? So if it has greater than 20% equity, then we put a lien against it. And the delta there is what is the collateral value. So if that's your situation and you walk in an SBA loan, we will put a lien on it. The other scenario is you go to the bank and you get a $300,000, or let's say you have a line of credit, and that amount's $800,000. So the 500 plus 300. Now there's only 20% equity. In that scenario, we cannot take a lien. So obviously HELOCs come into play a lot. You have a lot of people that set up HELOCs for the purpose of additional access to capital. And so I'd like to say that in cases where cash flow is strong, borrower is strong, personal financial situation is strong, without the pledging of a home, we can still do the deal. Like that's more common than uncommon. once you get into like 3-4 million plus, sometimes the collateral piece is a little bit higher. There's some banks that don't touch like just airballs when it comes to collateral on those larger deals, right? They need something. And some banks can do it with very little collateral. But again, everything else has to be pretty strong, right? Like there's not many collateral. Everything else has got to be real strong. So obviously the home is one. And not only is it a first primary residence, if you've got investment properties, second homes, sometimes somebody will send me a list. They own 10 homes and we have to go through each one and see which one has equity available. We could essentially put liens on all 10 homes if there's enough equity on it, if that's what we need to get to a dollar collateral position. And so again, you're talking, 10 appraisals. So it's going to kind of, it'll get done, but again, just more steps in the process.
Well, I think, and it's something that I've said many times, not to sound like a cliche, but every deal is different. So the magic of the SBA loan comes at the pairing of the right buyer and the right cash flow business, right? Which the bar, there's so many variables with the buyer itself, right? Renting versus not owning versus renting, management experience, pound for pound versus non-management experience in the industry, collateral or lack of collateral, post-closing liquidity versus lack of, and all these things. Location, we didn't talk about location, right? But how does location, businesses that can be run absentee versus semi-absentee. I know the whole game about, but if there are industries that I love that, that you can actually manage, like self-storage is a space I really like. And a lot of lenders love self-storage because it's just it's a real estate cash flow play, right? You're buying underlying real estate assets. But I think you covered it all. Glenn, is there anything that you would want obviously I'm going to have your information. I want my buyers to come directly to you. Is there anything that you wanted to know that we haven't covered?
No, I guess all that's left to do is sign the closing docs, right? We've kind of collected all the items. I'm there just on a video call like this. I'm there to kind of review the docs. So, the one nice thing about kind of me being involved in the process, I'm really there from our first conversation to you signing docs, right? I'm kind of the one constant, and I like it that way, right? I like to be involved in the process. It's like I started this thing, we started this thing together. I want to be there at the end because, it's pretty cool when they sign that last doc and you can say congratulations, right? It's like this,
and you do this.
See the joy. Oh, it's great. It's such a cool thing. And so yeah, obviously the closing process, right? So think about anytime you've bought a house mortgage, it's a packet, different documents. Obviously, you want to obviously take a look at them. I try to give high-level reviews of all the docs, answer any questions you have. You sign all that, gets typically scanned, sent to us. We try to book it right away, disperse funds, obviously depending on the day, either get out funds that night or the next day. And then, if there's a draw period, sometimes you might have a few months. If we built in some working capital, you have a few months to draw down the working capital. But that's, closing day it's my favorite day.
Well, you certainly have earned it by the closing day. There's people underestimate how much involvement there is from the BDO, from you. So, and you have energy you have energy to go around for everybody. You're one of the most energetic guys I know. So
I appreciate it.
Yeah, I think this has been great. I have nothing else other than grateful to you and our partnership and what you're able to do. And I'm happy to add Huntington Bank to my list of trusted referral lending partners and working with you and many deals. We already working at least in one deal. I got other deals to come, but I thank you, Glenn. You guys will be able to get a hold of Glenn. This video will live for posterity. So, Glenn, you will be getting those calls and people just mention my name and Glenn will know who they are. As I think at this point, it's time to stop and let you enjoy your weekend. Thank you so much, Glenn. And I'll be in touch with you with, anything post this video. So in the meantime, thank you.
Awesome. I appreciate you, man. Appreciate all the work you do. You are essential to the SBA world because, the information that you put out there, it's priceless. And even somebody like me, like I was telling you, I listen to your stuff. Even the people that did just about SBA loans, I like listening. I feel like I learned something. this program's always evolving. It's changing. Your credit policy is always changing. The SBA world is not a world where you know everything today, so you'll know everything forever. It is constantly always trying to keep up with what's going on. As you know, we've got some rule changes coming up. A lot of credit departments are going to be having to sharpen their pencils and update some things. And so we're still kind of in the early stages of that, but I know you'll have some videos out, and be tuning into those as well.
Yeah, I'm going to have you back. I mean, once everything is official, post August 1st, right? After August 1st, everything is kind of landing. There's still negotiations being played, right? So I'm going to have you back. I'd like to have you back once you know for what Huntington's Bank position is going to be post August 1st. It'll be interesting for us to have you back to talk about it.
Yeah, it's exciting. I'll say that it should be very exciting for borrowers, some of these changes. I'm excited to dive as soon as the changes kind of fully implement. I'm excited to dive into it and learn as much as I can, so that I can educate borrowers, and obviously love to come back and talk about that with you as well.
You're going to be invited back, my friend, not just Tampa, many times to come. So thanks again, and I'll talk to you soon.
All right, Leo, take care.
All right, bye.
For a limited time, I'm giving away my cash flow calculator, or is actually a cash flow workbook that allows you to calculate the cash on any business, whether on market or off market. Calculate by using the cash flow given to you, superimpose the debt service payments, and figure out how much cash flow is at the end of every month and every year, so you can make those decisions as to whether to buy or not to buy a business. It is my gift to you. All you have to do is click on the link below, and you'll be getting a copy of it.